If you're planning to buy a house in 2026, stop everything, because what I'm about to show you could save you from the biggest financial mistake of your life. Most people think they understand the housing market, but the truth is, the game has completely changed, and the old rules no longer apply. Let's go back just a few years. In 2020 and 2021, the housing market was on fire. People were buying homes sight unseen. Bidding wars were breaking out in every city. Houses were selling for tens of thousands of dollars above asking price, sometimes within hours of being listed. It felt like if you didn't buy right now, you would be priced out forever. The fear was real. The pressure was real. And millions of people made life-changing financial decisions based on that fear and pressure. Then something shifted. The Federal Reserve, which is basically the most powerful financial institution in the United States, started aggressively raising interest rates. And when interest rates go up, mortgage rates go up with them. Suddenly, the monthly payment on a home that cost $400,000 jumped by $700, $800, even $1,000 per month, without the price of the home changing at all, just because of interest rates. Let that sink in for a second. And here's where it gets really interesting. Instead of home prices crashing the way most experts predicted, the way it happened in 2008, prices stayed stubbornly high. They barely moved in most markets. So now you had a situation that had almost never existed before in modern history. Mortgage rates at 7%, 7.5%, even touching 8% in late 2023, and home prices still near all-time highs. Buyers were getting crushed from both sides at the same time. So what does that mean for you sitting here in 2026? Everything. Because we are now living inside the aftermath of all those decisions. And the market you are looking at today is unlike anything your parents or grandparents ever had to navigate. Now here's the first thing you absolutely need to understand about today's housing market. And this one concept alone will explain so much of what you're seeing and feeling right now when you try to find a home to buy. It's called the lock-in effect, and it is quietly one of the most powerful forces controlling the entire housing market in 2026. Here's how it works. Back in 2020 and 2021, when the Federal Reserve dropped interest rates to almost zero to keep the economy alive during the pandemic, millions of American homeowners locked in mortgage rates between 2.5% and 3.5%. These were historically low rates, the kind of rates that may not exist again in our lifetime. And those homeowners are now sitting on what is essentially a financial golden ticket. Think about it from their perspective. If you bought a home in 2021 at a 3% mortgage rate, your monthly payment is incredibly comfortable. Life is good. But now, if you sell that home and try to buy another one, you have to take out a new mortgage at today's rates, which are sitting around 6.5% to 7%. Your monthly payment could literally double, even if you're buying a home at the exact same price. So what do most of these homeowners do? They stay. They don't move. They hold on to that low rate like their financial life depends on it, because honestly, it kind of does. And this is exactly why housing inventory, the number of homes available for sale, has remained so dangerously low. It's not that people don't want to move. People always want to move. Life changes. Families grow. Jobs relocate. Divorces happen. Retirements come. But the financial penalty for giving up a 3% mortgage rate is so severe that millions of homeowners are choosing to stay in homes that no longer fit their lives, just to keep that rate. The result? Buyers like you are competing over a tiny pool of available homes. And when supply is low and demand still exists, prices do not fall the way logic tells you they should. So now you understand why there are barely any homes for sale. But let's talk about the other side of this equation. Because even if you found the perfect home tomorrow, actually affording it in 2026 is a completely different nightmare. And I want to show you the raw, uncomfortable math, because numbers don't lie, even when politicians and real estate agents do. Let's take a median-priced home in the United States. Right now in 2026, that median price sits somewhere around $420,000 to $440,000, depending on which report you read. Now let's say you've done everything right. You've saved diligently. You have a 20% down payment ready, which on a $430,000 home means you've somehow managed to save $86,000 in cash. That is already an incredibly difficult achievement for most working Americans. But let's say you did it. That means you're financing $344,000 at a mortgage rate of 6.75%, which is a realistic number for 2026. Your monthly principal and interest payment alone comes out to roughly $2,230 per month. But that is just the beginning. Add property taxes, which vary by state, but average around $300 to $500 per month nationally. Add homeowners insurance, another $150 to $200 per month. If your down payment was less than 20%, add private mortgage insurance on top of that. And don't forget maintenance. Financial experts recommend budgeting 1% of your home's value per year for repairs and upkeep, which on a $430,000 home means setting aside $358 every single month just for things breaking down. When you add it all up, the true monthly cost of owning that median-priced American home in 2026 is somewhere between $3,000 and $3,500 per month. Every single month, without missing a payment, without losing your job, without a single financial emergency touching your life. Now here's the terrifying part. The general rule of thumb that financial experts have used for decades is that your housing costs should never exceed 28% to 30% of your gross monthly income. That means to comfortably afford that $430,000 home by traditional financial standards, you would need a gross household income of at least $120,000 to $130,000 per year. And the median household income in America right now sits well below that threshold for most families in most cities. This is not a minor gap. This is a canyon. And millions of people are trying to jump across it every single day. Here is something the real estate industry will never say out loud. The current housing market is perhaps the most hostile environment for first-time buyers in modern American history. And it's not an accident. The entire system, the way it's structured right now in 2026, quietly but consistently rewards people who already own property and punishes people who are trying to enter for the very first time. Let me show you exactly how this trap works. When an existing homeowner sells their property, they walk away with equity, sometimes hundreds of thousands of dollars in profit, which they can immediately roll into their next purchase. They come in with massive down payments, strong offers, and financial flexibility that a first-time buyer simply cannot compete with. And then there are cash buyers, investors, hedge funds, and wealthy individuals who are purchasing homes outright with no mortgage at all. According to multiple real estate reports, cash purchases have made up a significant portion of home sales in recent years. When you're a first-time buyer showing up with a pre-approval letter and a 10% down payment, you are bringing a knife to a gunfight. Then there's the issue of credit and qualification. Lending standards, while not as reckless as they were before the 2008 crash, are still complicated enough that millions of deserving buyers get rejected or offered terrible rates simply because their financial profile doesn't fit inside a perfect box. Student loan debt, which is crushing an entire generation of Americans, directly impacts your debt-to-income ratio, which is one of the most important numbers lenders look at when deciding whether to approve your mortgage and at what rate. And here's the cruelest part of this whole trap. While you are waiting, saving, and trying to qualify, the market is not standing still for you. Every month that passes, every year you spend trying to get ready to buy, is another month where home prices in desirable areas continue to resist falling, where your rent is going up, and where building real wealth through homeownership feels just a little bit further out of reach. Here is a question that should make every working American genuinely angry. What happens to a housing market when powerful investors start treating homes not as places where families live, but as financial assets designed to generate profit? Because that is exactly what has been happening across America, and it is one of the most significant reasons why affordable housing feels impossible to find in 2026. Large institutional investors, we're talking about massive corporations and private equity firms, have spent the last several years aggressively buying up single-family homes across the country. They target affordable starter homes specifically because those are the properties that first-time buyers need most. They buy them in bulk, often renovate them minimally, and then rent them back to the exact same people who were trying to buy them. The family that wanted to own that home is now paying rent to a corporation instead of building equity for themselves. The result is a market where the homes that should be entry points into homeownership are being permanently removed from the buying pool. And as long as these investors are collecting healthy rental income, they have zero incentive to ever sell those properties back at a price that regular buyers can afford. Every time someone brings up the housing crisis, politicians and economists immediately say the same thing. We just need to build more homes. It sounds logical. It sounds simple. But in 2026, the new construction picture is far more complicated than that one-line solution suggests, and understanding it will completely change how you look at the market. Yes, home builders have been ramping up construction. New housing starts have increased in recent years, and that is genuinely good news on the surface. But here's the problem. The homes being built are largely not the homes that struggling buyers actually need. Builders are constructing higher-end properties because that's where their profit margins are strongest. Building an affordable starter home in today's environment, with elevated land costs, expensive labor, and costly materials, is simply not financially attractive for most developers. And then there's the local government problem. Zoning laws across America actively prevent the kind of dense, affordable housing that could actually move the needle. Single-family zoning rules, lengthy permit approval processes, and neighborhood opposition to new development all work together to slow construction down to a pace that cannot possibly keep up with demand. So while new construction is happening, it is not solving the core problem. The gap between what is being built and what average buyers can actually afford remains massive, and that gap is not closing anytime soon. One of the biggest mistakes people make when talking about the housing market is treating it like one single market. It is not. In 2026, the difference between housing markets in different parts of America is so dramatic that they almost feel like completely separate economies, and where you choose to live could be the single biggest financial decision of your entire life. On one side, you have markets like New York, Los Angeles, San Francisco, and Miami, where home prices remain stubbornly astronomical, inventory is painfully thin, and the idea of a middle-class family owning a decent home is becoming more of a fantasy than a realistic goal. These cities are seeing populations slowly shrink as working class and even middle-class residents simply give up and leave. Then on the other side, you have markets in the Midwest and parts of the South, cities like Columbus, Indianapolis, Memphis, and San Antonio, where home prices are significantly more reasonable. Inventory is relatively healthier, and the math of homeownership actually starts to make sense for average income earners. These markets are not perfect, but they represent something increasingly rare, a realistic path to ownership. The rise of remote work has made this regional divide even more important. Because for the first time in history, millions of Americans have the genuine freedom to choose where they live based on affordability rather than job location. And the smartest buyers in 2026 are the ones using that freedom strategically. If I had $1 for every time someone said, "I'm just going to wait for interest rates to come down before I buy," I would be able to afford a home in San Francisco in cash. This is the most common strategy people are using right now in 2026. And I need to be completely honest with you. It is a far more dangerous strategy than most people realize. Yes, the Federal Reserve has been slowly cutting rates. And yes, mortgage rates have come down slightly from their peak. But here is the cold reality. Most economists and housing analysts do not expect mortgage rates to return anywhere close to those 2020 and 2021 levels of 3% in the foreseeable future. The era of ultra-cheap money was a once-in-a-generation anomaly driven by an unprecedented global crisis. Waiting for those rates to return could mean waiting indefinitely. And here's the trap inside the waiting game. The moment rates do drop meaningfully, even to 5.5% or 6%, millions of buyers who have been sitting on the sidelines will flood back into the market simultaneously. That sudden explosion of demand, crashing into a market that still has very low inventory, will almost certainly push home prices significantly higher. So yes, your monthly payment might go down slightly because of the lower rate, but the price of the home you're buying will go up, potentially wiping out any savings you were counting on. The brutal truth is this: there is no perfect moment waiting around the corner. Every strategy in this market involves trade-offs. And the most dangerous thing you can do is assume that waiting is the safe, risk-free option. For generations, buying a home was considered the obvious, automatic, no-brainer right move for any responsible adult. Renting was seen as throwing money away. Your parents believed it. Their parents believed it. It was treated almost like a financial law. But in 2026, that assumption deserves a serious, honest challenge. Because the math has changed dramatically and the old rules simply do not apply the way they once did. Here is the reality. In many major American cities right now, renting the same home that you could buy is actually significantly cheaper on a monthly basis. When you factor in mortgage payments, property taxes, insurance, maintenance costs, and the opportunity cost of your down payment, buying can cost you $800 to $1,500 more per month than renting an equivalent property. That is real money that could be invested, saved, or used to build wealth in other ways. But here is where it gets nuanced. Renting only wins in the short term if you are actually disciplined enough to invest the difference. If you rent a home for $1,000 less per month than it would cost to buy, but you spend that $1,000 instead of investing it, you are building zero wealth. The homeowner, despite paying more monthly, is slowly building equity. So the renting argument only truly works if you treat that monthly savings as an investment, not as extra spending money. The honest answer that nobody in the real estate industry wants you to hear is this: buying is not automatically smarter than renting anymore. It depends entirely on your city, your timeline, your discipline, and your personal financial situation. We have covered a lot of ground in this video. The lock-in effect, the affordability crisis, the investor problem, the new construction illusion, the regional divide, the interest rate trap, and the renting versus buying debate. And after everything, you are probably sitting there asking the same question you started with. So what do I actually do? And here is my honest, straightforward answer. Stop waiting for the perfect market. It is not coming. The housing market in 2026 is broken in very real ways. But broken markets still have windows of opportunity inside them for buyers who are educated, prepared, and strategic. The people who win in this market are not the ones who timed it perfectly. They are the ones who understood it deeply and made decisions based on reality instead of hope. If buying makes sense in your city, for your income, and for your timeline, then buy. Not because it is the American dream, not because your parents said so, but because the numbers actually work for your specific situation. And if the numbers do not work, then rent without shame, invest the difference with discipline, and keep building your financial position until the equation changes. The most important thing I want you to take away from this video is this: your financial future is too important to be decided by fear, by social pressure, or by waiting for a perfect moment that may never arrive. Get educated. Run your numbers. Make your move deliberately. If this video gave you clarity, share it with someone who needs to hear it. And I will see you in the next one.